Great. Hi. Welcome. Hi, Ani. How you doing?
Great, thanks. And you?
I'm well, thank you. So today we're going to talk to Ani Patton Powers, who recently published a book called Adventure Financing. And I thought we'd just start and kick right off. So maybe Ani, you can briefly introduce yourself, and then I'd love to hear a little bit about what your inspiration for writing the book was.
Great, sounds good. Very happy to be here. Thanks for the invitation. And love getting to hear obviously more about the work that you guys are doing too, because you're featured in the book. In the opening pages, actually. So I have been in the area of impact finance, alternative finance, for about 10 years, and started out my career in mergers and acquisitions, more traditional finance, in the mid 2000s. And what I say is that I have my description is the 4 A's. So I am an author now of the book, Adventure Finance, an academic. I teach at the University of Oxford and London School of Economics, as well as the University of Cape Town and a few others. I'm an angel investor here in South Africa, and I'm an advisor. So I work with funders globally to help them allocate capital and create strategies and structures that do that. They'll align financial return and, well, sometimes financial return, generally financial return and impact. So that's essentially what I do. And why I wrote the book was because I've been focusing on financial structuring for 10 years in this impact space. And there just really wasn't a good comprehensive guide for what you could do that wasn't equity and debt and impact. And I teach this stuff all the time, every day, and was feeling very frustrated that there wasn't something that I could point to that said, here are all of your options. And here's how you think about them if you're a funder that cares about mission, and if you're a founder that cares about mission. And so I set out to kind of just write down what I'd been teaching. I thought it was going to take me a couple of months, and it would just be pretty quick, just basically just take one of my sessions and just, transcribe it. And that is not what it ended up being. It ended up being a 16-month journey with hundreds of interviews and just tons of data collected. And now it is, a 350-page book that I ended up pulling a lot out of because I ended up having too much. But so for me, it was really that I wanted something to say to people, and people were like, what are my options outside of traditional financing? I wanted to be able to say, here's something that helps you explore all of them. And that's why I did it. And that's why it's out in the world now.
Wonderful. Well, thank you for writing it. It's a really valuable resource. And as I read it, I was like, oh, I'm so glad somebody finally wrote this book. It's very, very needed. I think that most folks who are tuning in, either watching this live or at a later date, probably have context for my next question. But just to set the stage, why is this relationship between financing and mission and the format of financing important? Like, why are people reaching out to you asking for resources?
Such a good question. And I think it's one that we take for granted. Well, at least I take for granted. Maybe you take for granted too. Maybe we take for granted because it's part of our work, and is definitely not one that we should take for granted. When I started impact investing 10 years ago, it was very much still at that stage replicating traditional financial structures, because it was this idea that we were going to do well and do good, but in a lot of ways in the same way that we knew how to do deals. And what I felt from the beginning and pursued, and many others have too, is that by just using the same structures, the same types of equity short-termism, the need for exponential growth, the kind of traditional debt construction, we're just replicating the system, potentially with better intentions, but replicating the system that's gotten us to where we are. And I think there's been a real shift in the past, couple of years, where the need for impact and the need for ownership and the need for reconstituting some of how our capital system works has become more mainstream. And so then, when you're doing this with the intent, when you're allocating capital or starting a business with the intent to create social impact, it's become more commonplace to say, what type of ownership structure do I want as a company? What type of financing structures do I want to use as a funder? What type of capital do I want to raise? Not just, I'm a social business and I'm going to go out and complete the same kind of run that everyone else does through the equity investment field. So I think that kind of in some ways, the mainstreaming of the need for impact around climate and inequality and all of the things that we talk about, as well as this understanding that maybe trying to do this in the same way that all other companies and all our investments have been done isn't necessarily the way to completely change the system.
Yeah, I completely agree. I mean, when we started working, particularly in the US a couple of years ago, and the framing that we often use is it's not just about the what of impact investing. It's not just about what kind of companies driving impact that we're investing in. It's also as important for us to ask the question of how we're making those investments. When we started 3 years ago, it felt like we had like a couple of heads, people didn't quite grok what we were getting at. And over the last couple of years, I think as a result of climate change and social inequality and sort of the also shift in the dialogue around corporatism globally, there's so much more hunger and eagerness, I think, to see systemic change on even an individual deal level. So thank you for that. So, at Purpose, we're very focused on this question of ownership, and our work, as you know, primarily it focuses on steward ownership, which is a concept that we kind of invented that has really existed for a long time throughout cultures and legal systems. That's really focused on keeping power and control of businesses inside the organization or with stakeholders who are closely connected to it, and also creating structures that prevent perpetual extraction in sort of the normative way that we typically see businesses get resold for the highest value or just have value sucked out of them by investors or owners in perpetuity. And so what we see, or what I experience, is people kind of coming to us through the door of ownership and saying, I really want to structure this business differently for the following reasons. I'm a serial entrepreneur. This is my third business. I've gone down the traditional VC route and I don't want to do it again. How do I do it differently? Or, we're building a platform and it's inherently important that the people who are on the platform participate in equity or have a voice in the conversation. There are a myriad of reasons why folks are approaching us with this question of ownership, but through ownership, we get to alternative financing. And I'm curious, do you have the reverse happen where folks come to you through the door of, hey, I want to raise capital differently, and end up pulling at the threads of the conversation long enough that they get to this question of ownership? Do you see change happening in that space as well?
Absolutely. It's actually so funny that the way you framed that, because it makes total sense that they would come to you from that regard and get to the alternative financing. And absolutely, I would say even, myself, I came across, ownership in the variety of ways in which business structures, can be structured have always been part of the work that I've done, but really this reflection on ownership and wealth accumulation. And, it was really through my work on financing. And so absolutely for others, I think that, one of the things that really resonates with a lot of funders that I work with is, when we talk about the inequities that we're addressing, whether it's through the structures themselves, so through financial structures, or through investment process, which is something the book talks about a lot as well. How do we change the process so that we're not, the structures themselves can have definitely impact, but, how do we change the process? And then it leads on to this question of then how do we think about ownership? And, it's something that, I've seen a lot. So I'm based in South Africa and have been for a while. And, for the past kind of, decade, really thinking about these issues around impact investing. And then for the past kind of 8-9 years being in South Africa, seeing what can be, even with the best intentions, the extractive nature of impact investing in the global South, whereby investors come in, put money into companies, make them a success, potentially, create a bit of wealth amongst a small number of founders, and then take that capital and leave. And I think that reflecting on that, when you push funders to reflect on that, they do start to say, well, actually, that doesn't make sense. But what are the options? And I think that's where which is why, it's so fun to have this conversation and to get to work with you guys, because, the structures and the ownership, they go hand in hand. So it's hard to imagine, an equity structure that lends itself really well to, some sort of community exit. But it's much easier with some of the ones we'll talk about tonight around structured exits to create a plan by which you are empowering a company or a community to take ownership of assets in a way that still does work for funders. And so I absolutely see that. And it's how, pulling these, it's almost like you do a little bit of the things at the grocery store that at the end where like the candies that they tease you with. So you pull in with the things that are like, oh, that's exciting, and then you grab them for everything else. And so I think it's as people start to look outside of the boundaries of equity, debt, grants, and to see the larger spectrum, which is what the book tries to do. Part of that spectrum is rethinking who owns what. And that's so important. And it can be something that can be, as you said, like a next stage piece, like you're thinking about how it's capital allocated and then who owns what, or it can be you start there and then you move on to the structures piece.
Yeah. Okay. So what was your favorite, what was the most inspiring case in the book, and why?
I was thinking
it's a bit like asking you to pick among your favorite children or something.
It is absolutely. So it was funny because there was so the book is made up of a series of stories, and I think it was interesting. I wrote the first version of the book, and it was more essentially cases with the stories being used as examples. And shame, my first few reviewers were just like, this is kind of boring. Like, we know what you do and it's not boring, but this is kind of boring. And so, they really pushed me to reframe it and like make it about the stories. And I think that was such, incredible advice, and it was so difficult to weave in everything, but it's so true. Like, we care about stories. And so for me, I loved getting to know, these different entrepreneurs, and it is tough to pick. I think there are, so for instance, the redeemable equity, which I think we'll talk about the structures, but the redeemable equity structure, which is can I just share my slide quickly?
Please, yeah.
So the redeemable equity structure, I think, is a structure that I find very fascinating. And I'll just show you what that looks like here. Not what I wanted to do. There we go. So I think there's I've got my multiple screens up. So I'm like, all right, there we go. So does that look good for you? We good?
Perfect. Yeah.
Okay. So the redeemable equity structure is a super interesting structure whereby a funder essentially purchases shares in a company, but the contract itself allows for and actually stipulates the way in which those shares can be repurchased from the funder down the line. And so from a pure structure perspective, I love the redeemable equity case because for me, it solves some of those issues around this idea of needing to obviously create exponential growth, and the exiting to another entity, which a lot of mission-driven organizations do not want to do, and being driven on this path of continuing to have to raise capital after raise capital after raise capital, and instead, in this specific case between Fledge and My Turn, which is a US company, they had in the contract where the shares could be redeemed over time as a portion of their revenues. They were repurchased, and then so 50% of them were repurchased that way, and then 50% of them were repurchased in a lump sum later on. And so you can do this kind of combination. It can be one, it can be other, it can be only partially redeemable. So there's a lot of different ways to do that. And how that worked out for in this specific case was that there were 50 shares in essence that were sold, which equaled 60% ownership. And half of the shares, so 25 of those shares, were redeemed through quarterly payments, which were 3% of their revenues. And then the rest of the 25 shares were redeemed at the end of 7 years. And one of the other things that I really liked about this case in particular, which I didn't have for all of the other cases, was there was a conclusion to it. So it was, the case itself is essentially about 8 years old. It was the first type of structure that was done. And I think that, a lot of the other cases, I did choose slightly older cases to be able to have kind of this wrap up in them. But that was hard to find. But so many of the other structures and the stories are still a little unresolved. Because they're new, and who knows what could happen in the next year or two. I purposely did pick ones that had a bit of resolution because I wanted to be able to show that, and it was great that I was able to find and able to engage with ones that did. But I would just say one other one that was pretty fun for me. I really did enjoy. There's a case in the book that is I call it Provive, and it's a Mexican it's a Mexican housing, and the founder, I don't know if Antonio's watching, but just cracked me up in every interview. He's just the nicest, sweetest man. And one of my interns that was helping me with some of the transcription and things was just kept messaging me and she's like, he's hysterical. And I was like, oh, I cannot get enough of him. I think he's so funny. So anyway, so in case you're watching, that was one of my favorite sets of interviews.
Going back to the redeemable equity for a minute and kind of thinking about the other structures that you represent in the book, and I really like this spectrum. It feels like you're unpacking a little bit the assumption of this binary between debt and equity in a way that for me really resonates from the practice that we've seen capital get deployed into alternative structures. Who does that work for? Can you give us a little bit more context for the folks who are listening for My Turn and why that worked for their business, and any cases that you see where things like that don't work?
Yeah, absolutely. So I'm just going to do another visual because I think it's sometimes easier to look at, and you'll find in the book, one of the things that I have tried to do is to create essentially a self-evaluation to be able to understand what is appropriate and what's not. So we'll just talk through these really quickly. So for instance, on the redeemable equity side, which you had highlighted, so I found these work for both pre and post revenue companies. And that's one of the things I think is quite interesting for redeemable equity. It can be concept or what I consider early stage. It does have to be a high growth company projections wise. It doesn't necessarily need to be a high margin company. And because you can structure the redemptions to be, for instance, in a lump sum later on. So it could be financed by a third party as opposed to having to pay them off over time. So it's actually quite a flexible structure. That being said, there's a lot of work that needs to be done globally on it. Some of the work that I'm actually starting now, just around tax and legislation, it is a bit different. And so there is some gray areas on it, but as a structure, it's incredibly versatile and can be, and there's been examples of, another example I have in the book is of preferred shares that have been used in a similar essence to this. And so there are some examples historically, but it hasn't been necessarily used as much in this way. And so there's a bit of hesitation around it. Now, that being said, if you go a different spectrum over to the other side, so revenue-based financing, which is more debt-like, is actually a much simpler tool, but it is a bit more restrictive, which is fine because the whole point of this discussion, right, is that equity doesn't work for everyone, debt doesn't work for everyone. So there's going to be more options, and they're not going to work for everyone. So instead of trying to take a blanket approach, what type of capital do you really need? And I'll look at the evaluation in a moment, but revenue-based financing only works for post-revenue companies. And I have had people argue with me left, right, and center about this, but I have not found any good data that shows that you can do revenue-based financing with pre-revenue companies, because what you need to do with revenue-based financing is look at historic revenues as their collateral, and then future revenues you get a payment as a percentage of. And you can do this over a short period, over a slightly longer period, not a long-term period, but a slightly longer period. So it can be a few months, it can be a couple of years. Now, this is starting to mainstream, and we'll talk about this probably a little later, but this is starting to be mainstreamed, and it's a very interesting model. It works for post-revenue companies that are high margin. It does not work for very, very concept stage companies that don't have high margins or know what their margins are. And it works for kind of short to medium term, really for working capital, customer acquisition, et cetera. So it's a good tool for a specific use case. It can work for growth capital, depending on how it's structured. Now, there's another terminology that I came up with that is a bit of a mishmash, which is what I call convertible revenue-based financing. And this works for post-revenue companies. It's very similar to revenue-based financing, except it has a clause in it around convertibility, so it can convert into equity. And I've seen more venture capital-like companies using this, and they're more hands-on as opposed to the revenue-based financing companies that are a bit more debt-like. And how I have broken this down essentially to be able to evaluate it is through, excuse my flipping through a bunch of slides, is through an evaluation that I created right up at the front of the book, and then I use throughout the book going forward, which is really looking at who you are as a company, how you're registered, what stage you are, how mission driven you are, so how embedded is it, and then really drilling down into your funding needs, which allows me to, in the book, I mean, it's not this simple, right? There's not just a, if this, then that. But what I did do was put together a bit of a crib sheet for founders or funders, really looking at what is appropriate based off of some of these features. So, what do you need to have to be able to access some of these different types of funding? And I'm hoping that will be useful as people are thinking through these options, because there does seem like there's a lot of options, but there are specific things that you need. So for instance, if you're looking at something like trade finance, so invoice factoring or purchase order financing, if you don't have invoices, if you don't have purchase orders, if you haven't done other orders, you can't access that type of funding. And the same thing with looking at, if you don't have revenue, you can't get revenue-based financing. So I think that what I'm seeing is that there are a lot more options. There are a lot more options for companies, obviously, which is why there's so much of the book, but the companies themselves and the funders need to understand who the company is, what it's trying to do, and what type of funding it needs to be able to pick the right type of funding for that company. And it's starting to be a little bit clearer about what those relationships are. We still have a ways to go. We need more data to be able to understand this, but it is that relationship starting to be a bit clearer now.
Yeah. So I want to ask you two questions simultaneously. Okay. I'm going to stop myself from doing that. The first question that I have is around, what we've seen sort of in the market is that the further along you are, this is unsurprising, the lower the risk, the more history, the more stability, the easier it is to raise capital on alternative terms. And that really comes down to an obvious point, which is the risk return profile. We can get closer to a debt-like structure if we have, we do a lot of business succession cases in the US of companies that have 10 plus years of operating history and are doing a redeemable style of equity that you outlined, but where there's a, dividend bearing share, and at year X, the company and the investor have a right to redeem the equity. This question of risk return profile comes up all the time in our work, and I think is particularly challenging. The younger the business is, the more speculative the concept for the business is.
Yeah.
And so I'm curious, in your conversations with funders, how do you see folks navigating this question of what makes an appropriate risk return profile for a younger stage business where we are taking total exponential growth, uncapped returns off the table because we're venturing into the realm of alternative ownership and finance?
It's such a good question. And I think it's even one that's, Camille, it's interesting to kind of take a step back from the funder side. And this is what, I get to do when I speak to and work with funders themselves is, really asking them what they want that portfolio construction to look like. So a lot of funders say they want to fund super risky early stage businesses. But when it comes down to what they put into their portfolio and how they put their portfolio together, they aren't doing that regardless. Even if they have exponential growth on the table, they are still looking for companies that are a sure bet. They might still be using equity, but they're looking for companies that are a sure bet, that are, post-revenue, et cetera. And so I think that, there's a few different ways in which I'm seeing funders think about it. So one is to think about themselves as a funder. So are there ways, and hopefully we'll talk about this a little bit later, but are there ways that we can structure our own fund to be able to take additional risk? So what are the type of capital our LPs are giving us, or our funders that are giving us, that allows us to create a little bit of a different risk profile? Or another option is around that portfolio construction. So you can have a portfolio that is completely, like the traditional, let me just share my screen again. Let's look at the traditional portfolio construction of a VC, which people often do forget, how it actually works. It's a good reminder to remember how the VC portfolio construction actually works. So in essence, there's going to be one home run, and there's going to be maybe a couple doubles or triples, and then most of them are just going to peter out, single or just kind of, strike out. And this is from the book where I actually translated it into a few different sports
I really
metaphors.
appreciate it as someone who, plays poker but knows nothing about sports.
Exactly. Well, it's also like globally, I throw this stuff up there. People are like, who plays baseball? It's like, that's an American thing. Like, that's not. So we've got cricket on here. We've got soccer. I had to go to a variety of people to make sure I had all the right terms on here. But, so that for a traditional venture capital investor that is using equity to essentially try and get to that kind of 2.7 to 2.9 cash on cash return. So that's what they're looking for out of this. One's going to go to the moon, and then a couple are going to peter, et cetera, et cetera. So if that's the type of return that you're looking for, so you're in this kind of alternative state space, you are, imagining that you are going to be engaging with these companies where it is very unknown, or at least mostly unknown. I think one of the things that I do see, and where I see some of these structured exits, as we've discussed, coming into play, is where funders start to say, what if our portfolio construction looks different? Now, not going all the way, as you said, much easier to just get a bunch of debt-like companies, put them in place. You're looking at, an average of 3.5, 4 times return, and then a few drop off. That is one piece. Another way to look at it is to layer together some of those structured exits. So going with some of what would be considered slightly more debt-like, and then having some slightly more equity-like within an overall structure. So doing some of that risk mitigation within the portfolio construction. And then the other that I found, and this is again going back to redeemable equity, that I think is quite interesting, is using the tool itself. So we can talk about, at the funds level, you can do the different types of mixing of capital that can change your risk return. You can do it at the portfolio level, and you can also do it at the structural level. So what I've seen is quite interesting is that multiple of these funders are using redeemable equity, whereby say 50 to 60% of the shares can be redeemed, and they can make back essentially they can make their return based off of that redemption. So those dividends over time. But the upside in the fund is in every single one of those 40 to 50% shares that are out in those super early stage companies. So they only need one to hit, but they actually can, when they're looking at from their own LP perspective, they can make the case that the dividends they're going to make over the lifetime of the fund on average will actually get a decent return. So I think there's no easy answer for it, but I do think that there's, by opening up these different layers of thinking about risk return, as opposed to just we have to do less risky companies, or we have to do, grant capital. Like, I think there's a lot more nuance in, actually, how is the structure, the portfolio construction, or the fund itself able to make tweaks around risk and return to be able to take on the organizations that you're wanting to take on. And there's a few other kind of options. There's lots of other options in there, but I am finding that funders that are willing to be just a bit more innovative and kind of leave everything on the table, as opposed to saying, this is exactly what we're going to do. Now, that being said, obviously, this is much easier. And obviously, the funders that I often work with don't have the traditional GP-LP structure with a set of defined risk return kind of criteria. So it's easier for family offices. It's easier for foundations that have created funds. It's easier for high net worths. It's easier for DFIs, et cetera. So I think that the next stage of this, in the next book that I'm writing, is going to be around setting up fund structures that actually do make sense for this type of funding, because it's not just about the individual investments. It actually is about how that fund is set up.
Yeah, I want to get to that in a second, because as you know, we're working on a couple of alternative fund structures ourselves. But I want to quickly talk about process, because I think what we've seen, one of the examples that you reference in the book is Firebrand Bakery, which is here in Oakland, California, Candide Group and Anair. I think it's that chapter where you reference it. And we helped Matt, the founder, structure that deal. And the way that it happened was a very deep process of how do we structure this in a way that is equitable towards the company and ensures that the company is going to grow and be successful. That structure is very focused on employees and employee benefit. Firebrand Bakery focuses its hiring practices on formerly incarcerated and folks who are formerly without houses. And so this profit sharing and reinvestment in that community of people is really core to the mission. It was core to the impact that the investors were striving for. And the third component is, how do we structure this in a way that covers our risk return profile as investors? And what we came up with is this really kind of, we hacked a restaurant profit flip in that example where investors get 90% of distributed profits until they reach 2x. And then after that point, it flips and it's distributed pro rata based off of ownership. And there's a point on the line where either it's fair market value or a pre-agreed upon price for the shares. And it works really well in that example. The thing that we've seen in practice that I'm curious if you've come across at all is for later stage businesses, when we're doing a recapitalization, the challenge at times between recapitalizing a business where the fair market value far exceeds the economics of the company. So we see this a lot in tech, where there's a $200 million valuation, but annually there's only $5 million in free cash flow. How do you see, I don't know if you've come across this, and if not, that's okay, but how do you see folks navigating that? Because I think that's one of the biggest challenges that we see in practice, is this discrepancy between fair market value and, how businesses are actually performing based off of, in many cases, just industry.
Yeah, I wish I had a good example for that. I think it's one of those things that is, I'm quite keen to see, and that's why, a lot of the examples in the book were, particularly for things like redeemable equity, et cetera, are very early stage investors putting cash in, and then, that being returned to them at 4 or 5 times when, you've put money in the angel or seed round makes a lot of sense, even if it's at a really high valuation, but often because of that capped nature of it, so it's 5 times return. So it's, they paid $1,000 per share and you're giving them $5,000 back. And then that, makes sense for the company. I think, as we get more towards this idea of how do we convert these companies into full employee ownership and that mismatch, I'm really interested to see how we address that. I don't know. I really don't, other than, having, the structure early on, having a lot of employee contributions and or employee ownership that's built in early on, as opposed to waiting until later in the stage. But that doesn't help you if you've gotten to the end and you're like, well, I want to do this. You should have done it 5 years ago is not a very good answer to them.
And I think, sorry.
Yeah. No. I was gonna say, so the answer is I don't know. Yeah. And I haven't seen it.
Yeah, I think it's one of the many puzzles that we're navigating. And I think that for us, it's less about specifically employee ownership, although we see a lot of employee inclusion in the structures that we work on, particularly in the US, and more of this question of how do we create purpose, mission aligned structures in the long term that protect the long-term independence of a business, and overlaps greatly with exit to community and this question of what is an alternative exit for businesses further down the line. And I think that in addition to this question of financing, obviously is the question of how are you allocating control, and if depending on the risk profile of a company, if a complete protection of ownership isn't available at the very, very beginning of a company, what steps are you taking in your relationship with investors and in the structure of the business, whether it be through super voting shares or, a golden share or whatever else? How are you kind of increasing the level of security as you go through multiple rounds of financing is a whole other conversation that we can have.
But I think, and one of the things we see, right? So not to that, and there's, as you said, there's these spectrums of, even within steward ownership of being able to integrate the mission in. And so we've seen some really interesting, even just this year with B Corps going public, how, like, what is that relationship if you've embedded this in your mission is embedded in your company and suddenly you're traded on a public market. So what does that look like? And so I think that, these relatively existential but very practical questions around, what do you want to look like? It's one thing when you are a 5-person startup imagining it, and it's another when we start to think about really large, these companies becoming really large companies. And I think so that's part of the reason that you and I are thinking about these things, because it's part of the journey that we've started to be on now, because these companies are getting big enough and suddenly they are having to address this, and or they're coming to the point where later on they decide they want to make a change, but really we've had this progression of companies that have come through and they're saying now, what do I do? And I think it's emblematic of the space in general, of impact investing in general, that we are starting to get to the point where it's not sidelined, it's not a niche piece. It is actually, we've always said we want to be mainstream, so suddenly it's mainstream, but what does that look like in practice? And how do we think about the ways in which both investors and the companies that have become corporates deal with this ability and this kind of largesse that they have, and how do they continue to be able to walk that path?
Yeah. Cool. I want to give people time to ask questions, and I want to talk a little, just for a minute, about sort of the next.
Yes, please put questions. Put questions in the chat, or in the chat, or in the Q&A. Either way.
Yeah. I want to quickly touch on the alternative fund structures, because it seems to be like you have found sort of the next chapter of your work and exploration in that. And as I shared with you, we have been we are launching a fellowship program for emerging fund managers around this challenge. And it really came in response to getting reached out to by 10 or so fund managers who said, great, we've raised capital before in traditional ways, very similar to the founders who have reached out to us. We've done this path. We see the shortcomings of how we're structuring investments and our funds. If we're really looking to drive intergenerational impact, how do we do things differently? And so I'm curious from your perspective, like, what are the exciting trends that you see there, and where do you think that's going, and what's needed to make it move forward? We got a question.
So it's interesting because, so I actually, like, for me, it's more like I actually started at the fund side, because that's the work that I've done has been around structuring funds. Yeah. And then obviously part of structuring funds is capital allocation and deals. And so starting, from a published perspective at the deal side, I realized was very important, because you needed to make individuals understand how some of these alternative funds could work. Because if you just jump right into an alternative fund structure, people are like, yeah, but you invest equity into a company and then it comes out 10 years later. How does this alternative fund structure work? Right. So you have to understand the underlying deal structures and business structures and all these things. And so that was really, that is that grounding piece. And then you move to the fund structures. And so for me, I'm quite excited to get there, because I think there's so much happening. So just a few trends that I'm seeing. So obviously, permanent capital vehicles have been a topic of conversation for years, but there's been a real lack of growth in them, because LPs or investors, funders of any kind, really struggle to be able to understand, to be able to put these in the right box. And so fund managers that want to raise a permanent capital vehicle, because permanent capital vehicles make sense for underlying organizations, and they make sense for the fund managers, right? It is not having this artificial, 3-year period to deploy capital, 5-year period to, engage with company, 3-year period to sell company is just, is better for the fund manager. It's better for the company. But, historically, it's just been a very tough sell to LPs, because they don't understand the underlying liquidity. What does this look like for them? How does this fit into the box that they're looking for? So I am seeing, I would say, it's not a sea change, but I am seeing slightly more acceptance of the permanent capital structure, and partially because of who's raising the funds now. So there's multiple fund managers that are raising permanent capital vehicles on the back of successful funds. So it's, fund 3 or fund 4. And so when they go into the room, similar to an entrepreneur going into the room and saying, I made money for those people, they can go into the room and say, here's the capital that we have allocated back to investors based off of our previous funds. And here's how well we would have been able to do if we hadn't had to exit those entrepreneurs early. So it's more of a call for that. The other reason is because of some of these structures. So you can have a fund manager say, I'm going to do a permanent capital vehicle, and there's going to be dividends that are going to come out of these companies that are going to provide some of this liquidity for you as an LP. And here's what that's going to look like. And it's not as crazy. Even though it is, adding additional structures on there. Another thing that I'm seeing, which is very fun and right up the Steward-Ownership alley, is things that are taking on crowdfunding and taking it to the next level. So these micro funds that are being launched, obviously funds that are crowdfunding themselves for the crowdfunded funds. And then another element to that is something that some friends have recently launched in Canada called a syndicated rolling fund. Mm-hmm. Whereby you get essentially a set of investors in, and then they're subscribing to the fund in each of the quarters. And I think that playing with that democratization of funds and finding ways in which you're not just crowding in a lot of funders, but you're actually playing around with the tenor and how funders are engaging, it is quite exciting. I think what's going to be interesting to see, so there's also things like SPACs and search funds that are being launched, and it's interesting to see how those from an impact perspective will be utilized. Another one that I don't know if it's a trend or a an example, it's hovering between the two, we'll see, is something that's called an impact transformation fund that one of my students has done, whereby a traditional private equity model, except that what he's been doing is going out and looking for companies that he can buy and transform into impact companies. So buy companies that didn't previously have any sort of kind of impact or social mission embedded into them, buy them, and that's part of the value add, is actually adding that social mission. And I think that's an interesting take on kind of the vampire squid private equity model. And if you can, instead of ripping things out of a company, actually think about the ways in which you're embedding new into that. So yeah. I think that all fund managers know raising capital is going to be difficult, but where we are right now, what I'm seeing right now is there's a lot of capital out there. There's a lot of interest in putting capital to work. And so there are some very intrepid fund managers that are saying, if I want to be managing this money for the next 15, 20 years, I actually don't want to be tied down to the traditional LP-GP structure. And so I'm going to take this chance to raise a fund that allows me to allocate the capital the way I want to allocate the capital. And then just the last thing I would say is I love the work you guys do and the work that like Candide does around using fund structures to help this transition towards, distributed ownership, mission-driven ownership, steward ownership, however you want to call it. But this transition from kind of very traditional, few founders owning a company with, a mission statement kind of as a line item, towards companies that are very purposeful about how that mission is embedded in the ownership and the power structures of the company, and actually using investment to make that transition. And I think that's something that I see as being a trend in impact investing that's going to be very powerful. If we can show how, similar to the Impact Transformation Fund, if we can show how the injection, not injection of that capital is utilized to actually change the company itself to create more value for more individuals.
Yeah. Well, I could talk with you about that point for the next 2 hours, but I want to make sure that people have an opportunity to ask questions. So I have a couple of questions in the chat. One is, do you know any funds just willing to grant participating loans, fixed low interest plus variable interest conditioned upon performance, and the loan be to be repaid or converted? And the follow-up question is this sexy for impact investors?
So it's interesting. So let's see, Jose, it's a really interesting question. So I'm just actually gonna, because there's quite a lot, I'm just gonna share it here. So it's just a panelist. So I'm just gonna share it to the panelists and attendees so you guys can see what that is as well. So there's a couple of different things today that I'm seeing here. So there are MES funders that are doing these types of participating loans, and you'll find them. I've seen them across. I've worked quite a lot in Africa. I've seen them across Africa that are doing these for specific areas. There's some great work that was done by the Dutch Good Growth Fund that maps a whole set of these funders. So I'll quickly Google that link. They call it SME MES funding, and it's a bit more European, African, but there's a whole list of funders in there. Here we go. I'll just share this on the chat here. There's a whole list of funders in here that have, there you go, that do those types of loans. And then, the loan can be, there's a piece of the loan that can be converted. The upside can be warrants that can be converted, or it can just be a profit share. Whether or not it's sexy for impact investors, I don't know yet. I do think there's a place. I have MES funding in the book as a specific use case, and I think it can be super useful. I think that the nice thing is on the spectrum, it's not just revenue-based financing, and it's not kind of just the redeemable equity. It can be this nice hybrid. So I think that MES will continue to be a very useful tool, and as it gets more templated, It will be easier because it can be quite a complex structure. And I know a lot of Mez funders have struggled to be able to convey that structure to the underlying entrepreneurs that they're trying to work with. And so that is an issue. And so I do think that there will probably be more adoption of it in cases that do make sense. But I think right now it's still relatively bespoke and a few different funders that are looking at it. So it's just because it is quite technical. And from an impact investing perspective, it's if you've never done that type of mezz lending before, that type of participating loan, it can be quite technical in figuring out, what percentage of revenues or cash flows to take, what does the dividend look like, what do the warrants look like, how do you price those, can be quite difficult if you don't have experience with it. So I think it's going to take a bit more education on both sides, entrepreneur sides as well as funder sides, to do that.
I think the other point on Mesda that we're seeing is that on the capital side, it's difficult for larger institutions to deploy into Mez debt funds just because pension funds don't necessarily have private credit departments, and it just hasn't grown at the same rate because it seems like it's not as competitive. I think that may change over the next 5 years, but that's definitely something we're seeing as folks are going out to raise Mez debt funds, is that they're facing a challenge.
And it's a good point, Camille, because I was on a call last week with institutional investors talking about some of these structured exits. And, the thing that came across really was, a lot of these do fit in the private credit departments, and the private credit departments are starting to grow.
Yeah.
And so I think it is, just like for anything, when we are, unfortunately, it's capital constrained based off of who's willing to fund the funds to be able to do this. And so there is potentially an opportunity as these private credit departments of these large institutional investors do grow and become, I wouldn't say more sophisticated, but they just actually have more capital and the ability to do that, to allocate that. We probably will see more. And it'll be about then telling the story about how this MES or revenue-based financing or renewable equity, funds do fit into this private credit space to be able to get that type of capital.
Yeah. So I'm going to put Jonas's question in the chat. Do you think that alternative finance could profit from the expansion or expansive monetary policy from the Fed?
I think it already is. Actually, Jonas, I do. So I think, if we look at, and again, I don't really actually very often, I'm trying to think if I do very often, I try not to in the book that often talk about alternative, like as a term, because even though we do it all the time and I say it all the time, but because I think it's, alternative to what, like there is still this, going to be a bit of a branding, it's going to be interesting, but I think as a space that's something it is right now, it's alternative to mainstream. But then the question starts to become, when does it become mainstream? So for instance, Clearco raised $215 million a couple of weeks ago from big funders, including SoftBank. And so the question is, and on the back of, as it was announced in the Wall Street Journal, it was the headline was on the back of other alternative lenders, raising big. So I do think that as there's more cash in the system and there's, we have low interest rates, there is people are looking for yield. And I think that we're going to continue to see that. And what we're also going to see, I think, is that, their venture capital and private equity, the venture capital and private equity returns, I don't think are going to be as outsized in the future as they have been in the past, just because the markets are getting bigger. There's less of an ability to, squeeze out a 35% return year on year. And so I think that it's just like when we see big swings around the equity markets and suddenly people realize that, a loan investment, a fixed income investment that actually gets you, 7% is actually a pretty decent investment when, the market's returning negative 10%. It's all about what you're comparing it to, what the benchmark is. And so I think that as these alternative lending structures become more accessible to retail investors, institutional investors, as they have more of a track record, their ability to be priced on a risk return basis is going to go up. And so I think that, depending on what happens, I don't know what Janet Yellen's going to do. But as when there's this much capital in the system that is looking for yield, it's not going to necessarily want to be locked up for 10 years in a VC fund, because we don't know what 10 years from now is going to look like. So some of these alternative structures allow for a slightly shorter lockup time, if at all. Some of them are very liquid. And I think that opportunity for investors of having liquid alternatives is really interesting for a lot of investors, particularly from diversification from a portfolio perspective.
Yeah, it's a really interesting point. Pim, let me post this in the chat. Pim asked, this is probably a tricky one to answer, but do you have a couple of preferred favorite financing structures for funders from the ones that you mentioned?
It is a tricky one. It's like picking a child, but Pim, it's a good question. I really think, and it's probably because you probably noticed that I've already talked about it a bit, but I really think that redeemable equity structures are an interesting one to play around with. And there's a few different ways that you can play with them within contracts, but I think having this opportunity for angel investors and early stage investors to have some liquidity, so getting some of that cash back early on, I think is important from a returns perspective, but also important from a good angel investors and early stage equity investors are rare. There's not a lot of them in the world, and they don't have a ton of capital. But if they can get their money back faster and be recycling it into more companies that are, at this really early stage point. So Camille, to your point earlier of actually wanting to do more of these, bets. So if you're able to recycle some of that capital more, I just think it's really fascinating. And one thing we haven't talked about, Pim, at all, because we can't, I just can't talk about the entire book in a setting I've tried and it just doesn't work, is the whole area of impact linked finance, and really thinking about how do you potentially embed impact or sustainability goals within financing? And I think what's fascinating about that is that it's not just about small companies. So I have a whole section in the book about how you can do it in general. And there's some examples of small companies, but also, this year, sustainability linked bonds will be one of the fastest growing financial instruments on the market, worth, in conjunction with social bonds and green bonds, hundreds of billions of dollars. So I don't think we're that far away from being able to understand that we need to embed sustainability and impact into financial structures and how we price them. So for me, I think those are kind of both areas that I think are pretty fascinating. And I also just think, honestly, revenue-based financing for early growth companies just makes so much sense. It's just I think it's going to be one of those things that is going to just proliferate alongside VC, alongside other types of debt, and is relatively simple, doesn't need any regulatory changes. And so I do think that that's kind of one of those that I think we're going to see, which we already have. Thankfully, I said this in writing months ago before the clear coat, we're going to see more of these where people realize that we actually need flexible financing that is very responsive and very quick for these early growth businesses that doesn't necessarily look like VC.
Yeah, wonderful. Well, if there are no more questions from the folks who've tuned in, I just want to say, Ani, thank you so much for joining us. And thank you so much for writing the book. As I said, I think it's really a huge contribution. We are lucky enough to be interfacing with a whole generation of entrepreneurs who are really blazing the trail and doing things differently. And it can be difficult, and it can, I think, feel like there aren't a lot of resources or information out there. And so the book just feels like a really valuable asset for those folks. So thank you.
No, thank you guys for doing the work that you're doing. I mean, I started the book off talking about you. So it's fun to, I wouldn't have been able to write this without the examples. And I think that, I think one of the reasons I decided to write it was that we were getting to the point where it wasn't just examples, we can actually extract some best practices. Because writing a book of examples is one thing, being able to say, this is an example and this is how we're thinking about using it. And these are the ways in which, the best practices have evolved. And I think that that's where, I think there's still a long ways to go. But, being able to look into, say, multiple years of research, or well, not research, multiple years of doing this type of funding has led us to believe this is very different than just saying we tried this once. And that's what's nice is where we are now is we're starting to have that. We're still, at infant stage, but being able to look at, companies like yourself and many of the others that are in the book that have blazed this trail is important. Oh, I just want to mention, Alex, there will be an audio version of the book that is to do. I'm actually pregnant with my first child and due next week. So I'm going to put that off until after the kid comes, but we'll be working on an audio version of the book for later in the year.
Wonderful. Well, thank you. And, best of luck on the next chapter of your life as you, thank you for joining us and what could be the week of your due date.
Well, it'll be, this is my second to last, well, this is my last book, speaking event like this. I've got 2 more events that I'm running and teaching later in the week. And then she can come whenever.
Wonderful. Well, I look forward to talking to you again, Ani. Thank you.
Thanks so much. And I hope everyone enjoyed and have a great rest of your afternoon, evenings.
Yes.